What is up, guys? Welcome again to the Mango Monkey Show. I am your host. Today, we will talk about personal finance, investing, and building wealth. In today's episode, I will share with you what I think about whether I am better off investing in property, in an index fund, tracking Australia's top 300 companies, or in individual stocks, which I pick myself. I'm not a financial planner and I don't have any license to provide financial advice. So what is this video?
Nope. Yep. Nope. Yep. Nope. Yep. Nope. Yep.
If you're cool with all that, let's keep watching and let me know below whether you have seen a monkey in real life or not. A wise man on the internet once told me that I should never put all my eggs in one basket. But when I was young, I only had enough money to buy one egg. Does it mean I buy one egg? Or I buy no eggs at all until I can buy at least two eggs? Well, the reality is that most investors need to start by buying only one egg. And that egg can be either a property, an investment in an ETF, or a managed fund, or an investment in a listed public company on the stock exchange. Property is a type of egg which is very difficult to buy, and in most cases needs to be purchased with the help of a bank. But because you are getting the bank's help, you tend to get a bigger return on your investment. You get some passive income from the bank as long as your rental income and capital growth combined is bigger than the interest rate charged by the bank to finance your investment. Imagine if you have a garden you want to fill up with mango trees. If you only have $20, you can only buy one mango tree. But if you borrow $80 from the bank, you can spend $100 and get 5 mango trees. So you get a lot more mangoes every year. The mangoes represent your rental income. But also over time, each mango tree will have more branches, and each mango tree can produce more mangoes. So not only are you benefiting from leverage, you're also benefiting from compounding, from the growth of the mango trees over time. When you have 5 mango trees instead of 1, the number of branches multiply very quickly, and your mango garden will become a mango forest very quickly. When you buy a property, the bank does not monitor your garden too much. They know it is a garden and it produces fruits which have value. They let you live your own life and they keep doing what they do best, which is lending more money to new customers like yourself. So it doesn't matter too much if suddenly your neighbor steals your mangoes or steal one of your mango trees. You still have a mango garden with a few more trees in the garden. Eventually, the remaining trees will get bigger and you can get back to your original mango production level. On the other hand, if you buy an ETF, which is an exchange traded fund, or a managed fund, or shares in a particular listed company, and you use a margin loan facility to buy those investments, the bank will closely monitor the value of your investments. This is because they can monitor it remotely and it doesn't cost them anything to monitor. They don't need to visit your mango garden in person. They just go on the internet, look up the last traded price of your ETF or shares, and immediately they know the value of your investments accurately. So if your investments have come down in value, the bank will demand you to pay down your margin loan so you do not exceed the maximum leverage level based on the current investment value. Therefore, it is not safe to borrow money to buy ETF, managed fund, or individual shares, individual stocks. What this means is that you still have the power of compounding working for you, but you do not have the assistance of leverage. The bank does not work alongside you to build up your wealth. Therefore, instead of buying 5 mango trees, you can only buy 1 mango tree. This mango tree usually grows more quickly. It's like a supercharged mango tree if it is planted in the share market. It may produce twice as many mangoes, but it still doesn't produce 5 times as many mangoes. So if I was to choose between property or ETF, managed fund, or shares, I would choose property. As long as I have a job and I can actually get the loan approved and my debt doesn't become too high. In this show, I talk about buying my first home as soon as I have 5% deposit, especially if I'm a slow saver. Now, after I buy my first property, I will wait a few years before buying my second property, because for my second property, I want to make sure that the combined amount of both of my mortgage loans is less than double the amount of my net wealth, my equity and deposit in the properties. During this time, I would invest my savings in the share market. If you enjoyed this video or if you gained something from it, I would appreciate if you can like this video and subscribe to my channel. Thank you for watching. Have a great day.